Here's a quiet thought to sit with. You got a raise this year. Your paycheck is bigger, and yet your life feels tighter. Same job, same hours, same effort, but groceries sting. Rent feels heavier. Savings don't grow the way they should. It feels personal. It isn't. What's shrinking isn't your salary, it's the value underneath it. And the reason is mostly invisible. Let's start here. Imagine you're standing still on an airport walkway. The belt beneath you is moving backward, slowly, constantly. You can walk forward, you can even walk faster than last year, but unless you outpace the belt, you're still losing ground. That moving belt is the real economy, and most people never see it. Why does this matter right now? Because for decades, the system has changed quietly, not with crashes or sirens, but with policies, incentives, and math that favors appearance over reality. On paper, things look fine. Wages are up. Employment is strong. The economy is growing. Yet millions of people feel poorer every year. That gap between the data in your daily life is not an accident. So let's break this down, simply, calmly, step by step. First, what most people think is happening. You work, you earn money, you spend some, you save some. If you earn more than last year, you should be better off. That logic is clean, it's intuitive, it's also incomplete. Because money doesn't exist in a vacuum. Its value depends on how much of it exists and what it's chasing. Here's the uncomfortable part. Every year, more money enters the system than the year before. Not because people are more productive, not because goods magically increased, but because the system is designed to expand money itself. New loans, new credit, new deficits. This is how modern economies grow. And when more money exists, each unit quietly loses a bit of power. Not dramatically, not overnight, just enough that you don't notice until years pass. 10 years ago, a full grocery cart meant comfort. Now it means calculation. Same cart, same items, different feeling. That's inflation, yes, but not the cartoon version people imagine. Inflation isn't just prices going up, it's purchasing power going down. And here's where the story gets interesting. Your salary increase is measured in nominal terms, just the number. Inflation works in real terms, what that number can actually buy. If your salary goes up 5%, but the cost of living rises 7%, you didn't get richer, you got quieter poorer. And here's the twist most people miss. Inflation doesn't hit evenly. Official numbers average everything: rent, food, energy, education. But your life doesn't consume averages. You don't buy the economy. You buy food, you pay rent, you fill a tank. And the things regular people spend most of their income on tend to rise faster than the headline number. That's not conspiracy, that's structure. Housing isn't optional, food isn't optional, energy isn't optional. So even when inflation is called moderate, your lived inflation can feel brutal. Now let's go one layer deeper. Why does the system allow this? Because inflation, in controlled doses, is useful. It quietly reduces debt. If you owe money, inflation helps you. If you earn wages, inflation tests you. If you hold cash, inflation erodes you. That's the irony. The system rewards borrowers and asset owners, not savers, not salary earners. Over time, wealth flows upward not through theft, but through math. People with assets see prices rise: homes, stocks, businesses. People with wages see costs rise. Both are inflation. Only one side benefits from it. This is why someone can feel richer without working harder, while someone else works harder and feels poorer. Same economy, different position. Now comes the part that's hardest to swallow. Your raise is often designed to keep you compliant, not ahead. Companies adjust salaries to remain competitive, not to preserve your purchasing power. Governments celebrate wage growth, not real wage growth. And central banks aim for inflation targets that quietly assume your money should lose value every year. 2%, 3%. It sounds small until you compound it. At 3% inflation, money loses about half its value in 24 years. Half. Same salary, half the power. That's not a bug, that's the model. Now compare the hype with reality. Hype says, work hard, get promoted, you'll be fine. Reality says, work hard or you'll fall behind. Hype says, inflation is under control. Reality says, inflation is redistributed. Hype says, the economy is strong. Reality says, the system is stable. Your position in it may not be. This is why the stress feels constant. You're not imagining it, you're running on a treadmill that speeds up quietly, and no one announces the increase. Zoom out now. What happens when an entire generation lives like this? Savings feel pointless, risk feels necessary, debt feels normal. People chase side hustles not for freedom, but for survival. And trust erodes. Not in markets, in meaning. Because when effort no longer clearly translates to progress, people stop believing the story they were told. That's the real risk. Not inflation, but disillusionment. So here's the unresolved question to leave you with. If your salary keeps rising and your life keeps feeling smaller, at what point do people stop blaming themselves and start questioning the system that made this normal? That question doesn't have a neat answer. And that's exactly why it matters.